If you're not willing to do the learning work, you can't have financial freedom. You just can't. You have to study money. If you want to be successful with money, you have to study it. And that's why I love what you do. I loved listening to Mary Buffett's podcast on your thing the other day. If people aren't subscribed to your stuff, they really need to subscribe to it. One podcast isn't enough. You've got to keep listening.
Welcome to Financially Free Podcast with your host, Nay Torres. One of the reasons Nay could retire when he was 25 years old is because he was coached by the best. And now, through this podcast, so can you.
Welcome to the show, everybody. Today, we're talking about Svenda's manual. Welcome to the show, guys. Jan, how did you create this manual? What is it about? And David, how did you create this database? Because I was seeing some other podcast, and you guys went through 7,000 stocks in the OTC market. That's amazing. And you ended up with 400. What was the process like? Mr. Svenda, would you like to start?
Yeah, sure. Thanks a lot. Thanks a lot for the invite. Now, as you mentioned, we did do a lot of research in the OTC space. So I'm coming from a background of running a newsletter focused on the space. So for 2 years, I've ran a newsletter focused exclusively on the OTC space. I'm coming from like the deep value philosophy, basically searching, for the undervalued stocks in the forgotten market, let's say, of the OTC market, because a lot of people have sort of, a lot of prejudices about how the market works and whether there are actually meaningful opportunities. A lot of that comes from the fact that, there is a lot of stocks there. And a lot of them are just meaningless. A lot of them are companies that are either pump and dumps. That still works. Or they're companies that are really meaningless in terms of the product. People are trying to do some businesses that are not really great or so. So a lot of that kind of always makes people kind of feel reserved about the OTC market, because they just looked at it a couple of times and they saw, well, it's not really meaningful. It's not really something probably worth investing in. But if you actually do the work and if you go through the market, you will understand there's a lot of like specific investment opportunities that are worth looking into and actually investing. So I started the newsletter, and through that time I kind of went around the market and really looked at every single company or most of the companies out there, and pinpoint which are worth following. That the companies that are really should be in the focus of the investors. So that's kind of the main idea behind the newsletter, as well as the database with which we are now working on with David. So basically the database is kind of co-creation of us two, where I kind of came with my research from the newsletter which I used to run. David came as a kind of individual investor focused on it, but maybe he can tell you a bit more about it for sure himself. But for me, it was kind of the newsletter. I was always interested in the OTC market, and then I understood what is one of the main problems of the market, and that is knowing the companies that are meaningful, because there's just so many of them, and so many of them are just crap. We can talk about all the great examples like Bigfoot Company and so on and so forth, which is just a company that is looking for Bigfoot, and that's without a joke. And all these kind of crappy companies, but then you have also a lot of interesting stocks that can make you money. So that's a bit about me and how I kind of went about researching the OTC market. I know that you had Dan Schum on, right? As a investor.
Great guy. Mm-hmm.
Yep. Basically, he's doing OTC stuff, right? And very, very similar approach.
Perfect. David, how did you get involved with the project?
So I initially began getting interested in investing in 2013, and I started to study value investing, and then I became interested in the deep value side of things, so looking at Ben Graham's net investing, which kind of drew me towards much smaller companies. And then I realized that a lot of the most interesting companies could be found on the over-the-counter markets. So I picked up some of the old Walker's manuals, which are these old stock manuals that contain all these old strange companies that you don't really find much information about on the internet. And I started to look at other blogs that were writing about these kinds of companies, and I found Dan Shum's work, and I found Jan Svenda's work as well. So I decided to follow Jan's lead of working my way through the over-the-counter market stock by stock, and I looked through several thousand companies. And then I would write these companies up on my own investment blog, elementaryvalue.com. And then over time, I just kind of started getting closer with other over-the-counter market investors that were looking at these stocks. And then me and Jan had a chat and decided that it might be quite cool if we created a product where we pulled all the interesting companies that we'd found together to create a database that contained all the interesting and meaningful companies. Because the problem with the over-the-counter markets is that you've got several thousand companies there, but the vast majority of them are just complete garbage. They're not even worth looking at. They're just kind of like they could be frauds or pump and dumps or just kind of empty shells with no real value. So we have worked our way through thousands of stocks and basically picked out all the interesting companies and then compiled them into a database for other investors, just to save them hundreds of hours of work going through all these companies.
God bless you guys. And what is the process like? Do you have screeners, or do you call every company? Because every company is different how they show financial statements when they're not reporting to the SEC, especially great companies, dark companies. How do you do it?
So we will class each company that we find depending on whether they report with the SEC, whether they are reporting on their own company website, or whether they are just not reporting publicly at all. So we'll class these as kind of SEC compliant, grey reporting, which means you can get hold of some information, or completely dark, which means that the company is just not reporting any information to the public. And then we focus a lot of our attention on these companies that are either grey reporting or dark, and we conduct a lot of investigations into these companies to try and get hold of financials and find out information about the company, because these are often some of the most interesting value propositions for investors, where the largest mispricings occur simply because there's no publicly available information on them. So we basically do a lot of the hard work to find out that what's going on with these companies, whether they're undervalued, and then we add them to the database. And if we can get hold of financials for these companies that are dark by contacting the investor relations department, or finding some way of getting hold of them, we can then add these to our database so other investors have access to them.
I've seen that.
Yeah, I would just add, I guess the process is, looking at the OTC market is really way different than, your NASDAQs and NYSEs, just because of the lack of screening data. So for example, you mentioned, do you screen for them? Do you do that? A lot of times actually the best way to do that in the OTC market is really to go through, as they say, A to Z, which is like at one company after another, trying to understand whether there is an opportunity, whether there are financials, whether the financials are correct in for example, other screeners and so on and so forth. So actually relying on screeners in the OTC market, it can be very short-sighted because a lot of times the opportunity is so obscure or so specific that you can't screen for it. One example for all is Mills Music Trust, which is a great trust that owns royalties for songs, basically, and they just generate the royalties from songs each quarter, and they send you a dividend, right? Now, this company, for example, is SEC reporting, but it would be very hard to screen for it, right? Because they don't have any assets. They have the portfolio of the rights to the songs, but they don't show that on the balance sheet. They just show the corpus of the trust, which is basically just the cash positions and the movements and so on and so forth. They showcase the dividends, so you could find it, through the dividends. But a lot of times the websites don't have the right dividend yield, or you can't really find all of them, and so on and so forth. So a lot of times it's kind of different in that sense. And so you could screen for that and try to find it, but it would be very hard. But by going one by one, you can actually find the company and say, hey, this is is a great stock because, it can yield like 12% a year, for the past 3 years, even more now. So, these things kind of take time and are a lot of times manual if you want to have a really good command of the OTC market. So the process is, kind of 19th century, so to speak, for some investors, but that's maybe perhaps why there are still quite a few interesting opportunities out there, because the process is much more manual than in other places.
And that's why we're making this interview, because that's exactly what the advantage is hard work, but you guys are making it easier now. I noticed you have, I got the database, you have price to tangible book value, meaning if the company dies, how much you will get back, basically, as the only metric. Are you guys gonna add income, expenses, or something like that in the future?
Yeah, I can certainly go ahead with that. Yeah, we will. So basically, right now it's price to tangible book, just because to give a kind of basic overview of the valuation. So if it's really crazy undervalued, you will see below one price to tangible book, which kind of can give you a sense of I should look into it, because what's behind the mispricing, what's kind of there. One note to say is the tangible book is again also kind of manual computation, because we kind of know what we should deduct and so on and so forth. So a lot of time book value as a whole can be also misleading. So we just took the tangible book to kind of showcase what could be the opportunities right now. But yes, we will add price to sales and price to earnings. So revenue and earnings. Again, for the SEC stocks, it's pretty easy to get the information on your own. But we are going to focus on the gray and dark stocks, and where we're going to provide more information. So that's certainly in the works. Right now, yeah, the screening is for the fundamental data is limited to price to tangible book, although it can already kind of help you. But this will be another edition very, very soon.
Yes, we must mention that you guys have, like, in all of these stocks, a section where you can put all the opinions or ask questions and stuff like that for the 400 stocks that you have done. David, I was looking at the qualifications for every stock, and I see from bankruptcies, dark stocks, gray stocks, but I also saw Russian SEC. How come do you guys have a Russian SEC?
Well, I might let Jan take this one actually, because this is one of the stocks that he added to the database. So I'll let Jan answer that one.
Yeah, so this is a cool one. One of the sources. We don't have many foreign stocks there, so the OTC market is filled with foreign stocks as well, so Canadian stocks and so on and so forth. So when you talk about the 7,000, for example, stocks, it's usually US based stocks, right? So that's really important to kind of say that we don't really have many of the foreign stocks, because usually you can just go to Canada and buy it there, much more better. So it makes sense. But there are a couple of stocks on the OTC market that are worth following, and that's a Russian company, a Russian oil and gas company that has a huge cash position and pays out a lot of dividends. That's Surgut SGTPY, and that's a dividend play basically, and we covered it in our research as well. We had a guest contributor write about why he believes the stock is great. It's a preferred stock, so it pays mainly dividends, and it had some great dividend yields in the past years. And there is actually a way to kind of calculate the dividend yield before it actually happens, because you can kind of estimate the dividend from the operation. So that's why the Russian SEC there.
Got it. So I'm gonna ask each one of you guys, can you give us an example of a crazy undervalued stock that you have found? I know you mentioned the music one, the royalty one. Can you give us, each one of you, an example of what you have found looking at 7,000 stocks basically?
I'll go first, I think. Well, one that I came across, which was a really interesting company, was ECC Capital Corp, which is ticker symbol ECRO. And this was an old former mortgage REIT that had kind of got obliterated in the financial crisis of 2008. And I think the market had kind of assumed that the company was just kind of dead. So they just kind of left it, and the stock price drifted down for several years. The company went completely dark, and they weren't responding to shareholders or investors. There was no news coming out. That I'd come across the stock on the over-the-counter markets, and initially I kind of just went past it and didn't really pay too much attention to it. But another smart investor who I've become friends with, he decided to conduct a bit more research on the company, and he managed to figure out that it was still basically an operating company, and it was still receiving money on. It had ownership in some securitization trusts. And it had also received some payouts from some litigation. So he realized that actually this company was probably sat on quite a nice chunk of assets, and it was probably hugely undervalued. So he kind of built up a position in the company. I bought some shares, and some other people did, and they began to kind of apply some pressure on management to go current with the financials, to kind of update the website and put out some financials just to let investors know what the current state of the company was. So at that time, it was trading at about I think an eighth of a cent. So it was below a cent, and then they put out the financials, and it turned out they had like 7.7 cents in net cash and like 15.4 cents in book value. So the stock price basically shot up at 800% in about 2 days, just because the company put out some information and said, oh, well, actually we've got these assets on our balance sheet, we've got no debt, and we're actually a profitable company. So you very, very rarely do you ever see those kind of price moves on any kind of listed stocks, unless there's some kind of completely crazy event that occurs. But regularly you will see those kind of events happen on the over-the-counter markets, just because you're dealing with such small companies, and the information that's available is so hard to come by. It requires a lot of research and investigation. So then when that kind of information becomes public, you'll see these huge price moves, because these companies have such small market capitalizations, and often they're quite illiquid. The shares are not kind of widely traded. So as soon as there's any kind of demand for the stock, the share price will explode. So that's probably one of the most interesting ones that I've come across recently.
And for me, I think I can give a good example of one that was recently acquired, so recently kind of finished, or the thesis was kind of finished on this one. Basically, it was a car insurance company, and I think I like the example also for one other reason, and that is that it kind of showcases why the database could be very helpful for people. Because the car insurance company, it was a specialty car insurance company in the US, and basically it was labeled as dark on the otcmarkets.com. So this is the website, where all the companies are, and if you were to be, an investor, you would just kind of look at it and say, oh, it's a dark company. It's probably not worth researching, because maybe the financials are not, up to date. They are not really easily accessible, and so on and so forth. But actually, if you did the work, you would be able to find that, they report audited annual results, even quarterly results, and that you were actually able to analyze the business. The name of the company was Gainsco. The ticker is GANS. It's still trading, but it's the last days of the trading before the merger happens. Or at least that's how I checked my brokerage account last time, but I'm not super sure whether it went through completely. But basically, what happened there was, and why I want to highlight it, is that this company has been producing so much cash flow. That was one thing that really caught my eye. So it was trading below tangible book. So basically, it was a company that was that had a market cap of like 50 million or something like that. Tangible book's about like 100 when I first found it, so you can see that actually there was upside even in that. But then you also had the cash flow, which was very, very strong. They were able to produce around 10 million, I think, in free cash flow, and so on and so forth. So the free cash flow yield was also very high. So basically, it's kind of like that class, like the gem that you're looking for if you're a value investor. Like, it's priced at fraction of tangible book, and it's creating cash flow. So there's not really like some sort of ice cube, so to speak, or an asset that would have value only if unlocked. And they, on top of all of that, they were actually paying dividends, special dividends. So not every year, but like every 2 years, they paid out a nice special dividend, a couple of dollars a share. So when you look at that, you start to think like, what's wrong? What am I missing? I mean, this is a great opportunity. And since I dig into it, I really couldn't find much. I mean, they've been just running their business, really well. I mean, it was after a turnaround, so the company had some troubled past, but basically after 2010 it was turned around by a skilled management team, and the cash flow was really, really strong. And I first found it in about 2017, when it was maybe perhaps like 14-15 dollars a share or something like that. And because I was going through one by one, one company after another, I was able to give the time to research it properly and to make sure that I find out whether there is an opportunity or not. Once I did the analysis, I mean, it sounded like a no-brainer, and then it went up 100% over the past 2 years, which was nice because the operation just continued to generate cash flow and so on and so forth. It was just still a no-brainer. But then recently they were acquired in September for about $100 a share by a different insurer. So I mean, this was a nice exit. So almost 8 times or so the return. And the whole point was that this stock, it was not really obscure. I mean, we for example, David talked about a dark company and these kind of event-driven situations, which can be interesting, but for some it might be just a bit obscure. But really, the OTC market is not only about that. You can really find companies that make sense, are not hard to analyze, and actually you can get some sort of advantage just by doing the work. So I think this is a great idea, or a great showcase of how the database actually can help investors, because with the database you could have known about Gainsco, you could have tracked it, and you could have did the analysis yourself and see, well, it's probably still valuable even if it's trading at $30 a share. So that's my favorite kind of crazy undervalued stock, because even though the return might be okay, it was great, of course, and so on and so forth, but still, I think the whole point was that this was an easily analyzable situation which you could really understand, and everybody could understand it, and it was just there. And I guess not many people, or not many investors, found about it, did the research and got to know about the company. So that's my story.
Yeah, that's why I wanted to make this episode. I think this is exactly what a young Warren Buffett will do. He will look into the dark stocks that they take some time, the amount of work that you guys are putting in, because that's where the jewels are. The big stocks are already, so many people are looking at them. They're overpriced or fairly priced. But this is what you have to do if you want to have big returns. I want to make a couple of questions about those two stocks that you guys mentioned. First of all, David, you mentioned that the stock you mentioned, there was some pressure onto management for them to put their financials publicly. How was this process? Because that's very interesting to me. How do you pressure the management? Do you sell emails? You call them? You do a proxy fight?
Yes, so this company in question, some other individuals, I think one of them who runs a small value fund, acquired a reasonable sized position, and then he basically contacted the management and said, look, well, we'd like you to put out some financials and raise kind of investor and shareholder awareness about the company. We've done our research, and we know that the company is massively undervalued, and that you're sat on a nice asset base, and you don't really have much in the way of debt. And in that instance, the management was amenable to becoming more open about the company, and they were happy to put out updated financials. Whereas in other instances, with some companies on the over-the-counter markets, management are not very interested in putting out financials, and in some cases you have to kind of take them to court in order to get hold of the financials. So every situation is slightly different. You'll find with some companies, you can literally just email the secretary or call them up, and they'll just mail you out financials, no questions asked. So I've had financials mailed out to me from America to the United Kingdom, in paper mail, no questions asked. I didn't even own shares in the company, and I just emailed the secretary, and she was very happy to send them out to me. Whereas other companies, I may contact them and they don't want to talk. They maybe no one's spoken to them in a long time. They're such a small company, and they have no investor relations department. They're not used to people asking about the company. So over time, you have to develop a number of different techniques that you can use to research these companies. So we will use things like, we will use Pacer, where we will go and look at court documents. We will use Google Street View to go and look at the premises, maybe see how many cars are parked in the parking lot to figure out how many employees they've got. We'll use land tax records to figure out what land that the company owns and how much that land is worth. So over time, we built up a lot of different techniques to try and figure out what's going on with some of these companies that are dark, to figure out whether we think there's a situation where there's going to be an undervalued stock there. And anytime we find an interesting company or an interesting stock like that, we add it to the database, and then we provide our comments about the company and any information that we've managed to get hold of. So if you get access to the database, you get access to around 50 different financial reports for dark companies which are not available in the public domain. So all this kind of information and these techniques we've built up over time, we essentially have just kind of channeled all that into creating the database, just to help other investors that maybe don't have that time to conduct that research, or they're kind of busy with other things in their life.
So the moment you find an interesting stock, do you put it on the blog? Do you wait a year to release the manual? What do you do?
So the minute where we will add any interesting new companies that we find, we will be adding those to the database over time. So that as soon as we find them, it will be literally probably a few weeks, and then they will be then added to the database once we've conducted some research. Sometimes we may wait because we want to kind of build up a bigger picture on the company. We want to maybe try and get hold of financials or conduct some due diligence. But generally, there's a fairly short time lag between when we find a new company and then when it gets added to the database. And we're also monitoring for companies that are delisting from the main exchanges like the NASDAQ and the New York Stock Exchange. They will kind of find their way onto the over-the-counter markets, and they'll then be added to the database as well.
Thanks, David. Okay, so Jan, what are the main problems of OTC? Investing in OTC.
Main problems. I mean, I guess for people who do you mean for people who want to start investing in OTC, or?
Yes, those people are just starting out and looking at the OTC market. They should be aware of this, and this.
Sure. Well, I think there should be a disclosure here, really, definitely, that the OTC market is very different in some ways, and the risks are really not very similar to the listed market. I think for people who want to start in the OTC, I mean, they should have already had some sort of investing background, not necessarily anything great, but just investing in the public market. I think that already helps a bit. Just because it can be quite crazy sometimes. Some of the situation can be illiquid, so when you hold Apple, you are confident that you're going to sell Apple the next day, Apple stock, but here in the OTC market, sometimes it can become illiquid, the stock, so you can't really sell it that fast. So I think that that is one thing to take in mind, the liquidity of the position and the stock. How easy is it to get in, to get out? Of course, if you're dealing with, let's say, smaller amounts, I think it's very easy, and actually that's also a kind of advantage, because if you have smaller amounts, you can actually take advantage of some of the stocks that other bigger investors could not accumulate. But perhaps that's one thing. Second thing is knowing that you're not really getting scammed. This is, I think, fairly easy into the OTC market, because if there are frauds or if there are pump and dumps in the OTC market, it's fairly obvious that they are, and there have been so many like cryptocurrency schemes and whatever have you, and now COVID related schemes for sure, where, they would start putting up press releases and start showing that, oh yeah, the business is booming and so on and so forth, but then actually in reality it's just nothing. But a lot of times in the OTC space it's very visible, because you can, for example, pull up the SEC filing or try to find more information, and if you can't find the information, probably it's not worth investing. So a lot of times, that's kind of something you have to be careful about, but I think a lot of times it's just very easy to understand that, this sounds fishy. I probably don't want to invest in the next vaccine, COVID-19 vaccine, which is somehow, being developed in Cambodia. Totally real, totally could happen in the OTC market, I think. So there are these examples where it's too good to be true, and it's very easily analyzable. So but on the other hand, there is kind of like a different process, different due diligence that you have to do in the OTC market space. But of course, with the database that we have, you can kind of get a head start, and you can kind of see our comments, you can see what's been happening. And the database is one thing, but of course, I did a lot of research in the past, which you can also purchase. So, there is older research that you can purchase that is actually very helpful, because that can give you a good insight into a lot of the stocks that are in the database. So perhaps the main problems, is a bit of the trading itself. Secondly, it's a bit of different process, different due diligence, and then perhaps things that are attached to those two challenges, and are kind of in between those two groups, let's say, of risks. But I think that is probably the biggest two.
Thank you. So I have two more questions for you guys. What's your position sizing? How do you see position sizing regularly? In my case, just to make a point, is if I invest somewhere from 1% to 3%, is because I'm kind of speculating maybe this will work or not. I'm not very sure, but statistically that stock seems cheap, so 1 to 3%. If I have some certainty, it will go up to 10%. To 20, even 30%. What is your position sizing like?
So I'll answer first. Personally, I hold quite a lot of stocks in my portfolio. I tend to follow an approach which is quite similar to Dan Shum. So I'll own maybe 30, 40, 50 stocks, but I'll probably only put maybe 1-2% in each one. But then occasionally, if I find a certain situation with the company where I think it warrants a larger position, then I may kind of go in heavier with that company. But generally, it's kind of a small position in a lot of stocks, which is kind of influenced as well by the approach that Walter Schloss used to take, where he would kind of just buy a large basket of undervalued companies and then just kind of wait for them to play out. So that's the kind of position sizing that I have.
For me, it really varies, but on the long side, because I do quite a lot of short selling as well, but like on the long side and OTC space, I think concentration can be pretty good if you have long-term horizon. So I think one thing to take into account is just how long you're capable and comfortable with holding, the assets. A lot of times in the OTC space, I think some of the thesis has to play out, over years. Some of them not so much. Some of them can be within a month, within half a year. But a lot of times it's about, the comfort levels of the duration. And so for me, for example, I'm very comfortable with holding something for 10 years, even if it's not really going to move that much. For example, it's a dividend yield or so on and so forth. So that's one thing. And then for the percentages, concentration is pretty good. I would not go above 10% personally, because I had some bad experience with that very early on, and I think that one of my rules is not to go over 10% ever. And with the statistical opportunities, yeah, I mean, of course, you can build up a position quite early on, start small, and just track the company and track the developments. I think I would have very much a similar approach in that regard to you. And the only thing is, yeah, not to cross 10%. So I don't really make a huge philosophy out of it, or have a specifically kind of like a statistical approach where I would somehow try to manage the portfolio too much. But in the OTC long space, I think the concentration can be a good thing, but you have to be kind of careful with how long you are capable of holding it, and so on and so forth. Yeah. Otherwise, of course, you can have a portfolio of many stocks that might start to move, but perhaps maybe that's where David can come in as well a bit, because he's doing a lot of research of low price stocks and waiting for the turnarounds or some events that might unlock some of the value, where of course it makes sense to go for a larger portfolio and try to let's say diversify. But in my mind, in the long space, in the long side of the OTC space, for me it's about quite concentrated.
Thank you, guys. And the final question: What would you tell yourself when you started this whole stocks and investing in stocks journey? Let's start with David.
So initially, when I started investing, I was probably what you would call a Buffett bro. So I was kind of like infatuated with the modern Warren Buffett, which was looking for these large companies that had durable competitive advantages, and thinking of buying these companies and then holding them forever. Over time, I realized that was just not a really suitable approach for a small investor to take. The whole reason that Warren Buffett uses that approach is because he's dealing with hundreds of billions of dollars, so he can't go and buy these kind of tiny little companies anymore. So then I found an interview that he'd done. I think he was asked a question by someone. He was asked basically, what would you do if you were starting out with a small amount of capital? And he said, I would be looking at these tiny companies on the over-the-counter markets, the secondary markets, and I would be trying to find really undervalued situations. So I think if I could give myself some advice when I first started, it would be to go straight to looking at these very small, very illiquid companies on secondary markets, rather than looking for large companies that have moats, because that's just not really the best approach for a small investor, in my view. I think the small investor can gain an advantage by going where the large institutions can't, and that is basically looking at these tiny companies that are on the over-the-counter markets and maybe the AIM market of the London Stock Exchange. If you can focus your attention on these really small illiquid companies, you'll find much greater mispricings, but also you can kind of have an advantage from information arbitrage. If you're willing to conduct a lot of research into these small companies which are way under the radar, then you can do quite well for yourself. So I think that's the advice I would give myself.
Yeah, and for me, I think it would be the same, which perhaps is not really a surprise, since we are doing what we're doing right now, and that's of course maybe a slight bias, but I think it's about informational advantage. It's really about what David said, where if you're trying to hunt where everybody else is hunting, then of course you're going to have a lot less probability of finding something interesting and finding a piece of information that actually not many people have. It's not about having the information that nobody else has, but it's about having information that only few have, and that's already good enough. And I think in the OTC market, it's probably high probability that you're gonna find something like that if you are going to focus on it. I think I'll be careful with starting out, all guns blazing and just investing a lot now in the OTC market, but carefully, trying out a few stocks, trying out the research and so on and so forth, because it is about that information advantage that you can you can attain in the OTC market, right? And in investing, that's all there is to it. If you know some things that other people don't, then you won, right? You're gonna have the better outcome. So that's the core of investing. And I think a lot of times some smaller investors might think, well, nowadays that's kind of impossible, or they might seem it's not really attainable. But I think that if you go small and if you start looking in the obscure, you can probably find something that really works. One good example of information advantage, because it kind of seems elusive, right? It seems like, okay, can I really find something that actually where the information is not really out there yet, and can I actually gain advantage of that? I think one example from the OTC space for me was a company that was being acquired. And so what happened was that I was just going through the OTC market. I was going, one by one, and then I stumbled upon this company, and I knew it before. I looked into it, but it wasn't really that interesting. But I looked into it, and it was after market hours, so basically the market already closed. And I just kind of did my usual search. I looked at the website, I looked at the press releases if there are any, and I suddenly noticed that after hours in the market, so that day they announced that they're going to be acquired, basically, and the share price of the company was $1, so it was about 6 or 7 p.m. EST or something like that. And basically I said, well, I mean, the share price is $1 per share, and the merger or the acquisition is going to happen at $2. So basically someone is paying 100% more than what the market was paying for the company just before the market closed, and of course before the news of the acquisition. And basically I thought to myself, okay, you know what, I'm gonna give it a try. I'm just gonna set up an order, and I'm gonna try to buy some shares the next morning, and I'm gonna try to buy for 120, 110, just a slight premium to the closing price, but of course a lot less to the acquisition price. And I'll see if somebody can actually sell me the stock for that price, right? It wouldn't make any sense, right? Because the information is out there. It's going to get acquired at $2 per share. Why would you sell it to anyone at 110 or 120? So I was just like, okay, well, I'm just going to give it a try. I'm going to put a few $100s here and see what happens. And guess what? Actually, I the next day I kind of just did my usual stuff, worked, and then I looked at my brokerage account, and I saw that actually someone sold the company, sold the shares to me at, I think overall like the average was 125 or something like that, and I was able to sell that the very day for $2 a share, just because the market finally realized, oh shit, there is a merger going on, the acquisition, and actually the right price for the stock is $2, not 125 that someone sold it to me at that. So this is really the epitome of kind of information advantage, which can still sometimes happen. Again, of course, this was rather an oddball situation. It doesn't happen that often, but it boils down to this, where it's like something that not many people know, and you can take advantage of that.
Thank you very much, gentlemen. This has been a great episode. This is exactly what I think people should start with if they're willing to put the time into it. Start with the A's. David, what's your blog? Where can people find you?
So you can get in touch with me at elementaryvalue.com, which is a blog where I write about these tiny little companies. And you can also get in touch with me on Twitter at elementaryvalue.
Thank you very much, Mr. Young. Where can people find you? And
So the best thing is to for the listeners to check out svendamanual.com, where you will be able to get access to the database that we've talked about so much in this episode. So that's the best way to contact me as well. But I'm on Twitter as well. It's just my name, Jan Svenda. But yeah, do check out svendamanual.com, where me and David are building the database and providing commentary and providing some updates for people interested in the OTC space.
Thank you so much, gentlemen. It's been a pleasure. See you in next occasion.
Thanks a lot.
Did you learn something today? How can you apply your insights? What's next for you? The fastest way to make things happen is to just share this podcast episode with more people that may find it valuable too. Talk about it with them and surround yourself with like-minded people. Hope you found this valuable. Don't forget to subscribe. See you next time.
This podcast references opinions and is for information purposes only, not intended to be investment advice. Seek a duly licensed professional for investment advice.